70% of these funded AI startups still do not generate real revenue. This has raised alarms among some experts who claim that the AI boom could be turning into a bubble, like the dot-com bubble of the early 2000s.
Hype cycles come and go. The metaverse, Web3, crypto. What about the mother of all tech cycles, the dot-com bubble and burst? So right now, are we in the middle of another one with the generative AI and ChatGPT?
So, how AI became the new dot-com bubble.
Hey everyone, welcome back to the Future of Work Weekly Report, where we call bullshit on the idea that AI automatically makes you work faster, smarter, and better. Here's the disconnect. 96% of executives expect AI to boost productivity, but 77% of workers say AI has added to their workload. It turns out asking AI to do your work without training is like owning a Tesla and not charging it. Frustrating and pointless. Workers say they're spending hours reviewing AI-generated content, fixing hallucinations, and crafting prompts that actually generate output worth editing. 77% say productivity dropped. 40% admitted they don't know how to make AI work. Meanwhile, leaders are soaking in PowerPoint pride, confident that AI will eliminate headcount, despite no evidence companies have saved anywhere close to 20% staff yet. That's not ROI, that's expectation inflation. Josh Dreen calls it the productivity paradox. AI isn't automatically making work lighter, it's forcing outdated models to try harder. Two forces are on a collision course. Companies rushing AI into outdated workflows, employees expected to learn, adapt, and fix AI on their own. According to Kelly Monahan at Upwork, AI tools work only when humans intervene. Humans must review, judge, and adapt every output. No oversight equals no value. And Gartner adds that this hype bubble is huge and disproportionate to the actual impact today. And just as a side note, I've experienced this myself whenever I use ChatGPT or Claude or Perplexity. It's not that AI isn't helpful. It is, but it basically makes every single person a manager. And that's okay, but don't expect increased productivity. Whenever an individual contributor is managing their coworker, their AI coworker, they're actually managing the output, right? So they might not be necessarily building the work from scratch like we used to, but what they are doing is they're managing and tweaking it. And in some cases, from my own experience, I found it better to start from scratch and then throw it in to ChatGPT or whatever AI tool that you're using. And even then, it's not perfect. So it's this catch-22. It can help us, but it can also slow us down.
Many users report that these models provide inaccurate, shallow, or outright incorrect responses. In practice, generative AI has proven more effective in supporting repetitive tasks than in disrupting entire processes. This has led to a disconnect between the futuristic promises made by companies, such as replacing 80% of administrative jobs, and tangible results. Moreover, much of the value of these startups is based on expectations of future revenue that have yet to materialize. Revenue projections are, in many cases, speculative. According to data from CB Insights, more than 70% of AI startups that received funding in 2023 and 2024 still do not generate operating profits. Added to this is the fact that talent and early-stage company acquisitions by large corporations have increased by 40% in 2025. In other words, returns on investment remain uncertain, raising doubts about the sustainability of this speculative wave. In addition, the productivity gains from AI are being questioned.
Tech giants like Microsoft and Google are outsourcing more and more coding to AI in a productivity push, but some new research shows the tools might not be as helpful as some expect.
Another troubling symptom is the disconnect between stock prices and economic fundamentals. NVIDIA, one of the largest AI chip suppliers, lost nearly 17% of its market value in a single day after the release of an open-source model promising similar results. Although NVIDIA has greatly benefited from the AI boom, this event showed how volatile current valuations are, where future expectations can collapse with an unexpected competitive breakthrough. On top of that, there is a risk of financial contagion. The excitement over AI has pushed other speculative assets upward, including cryptocurrencies, echoing the asset correlation phenomenon during the dot-com bubble. Back then, the Nasdaq crash dragged down nearly 1,500 small tech companies and had a systemic impact on global markets.
Down 1.7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate.
Today, a negative event in the AI ecosystem could trigger a similar domino effect, given that many institutional portfolios and venture capital funds are heavily exposed to the sector. On the other hand, regulatory and social ecosystems could also limit AI's future growth. Various entities, including the European Union and U.S. authorities, are working on regulatory frameworks that could impose restrictions on data use, privacy, or copyright.
But here's what smart companies actually do. They run focus groups to find real pain points, offer targeted training. They don't just push employees into AI tools. They teach teams how to spot hallucinations and doubt outputs like phishing alerts. That's coming from McKinsey company. But that's how you move from forced adoption to informed use and stop AI from being just another productivity myth or distraction. Generative AI isn't a magic bullet, if you can't tell by now. It can speed things up, but only if organizations properly integrate it into workflows, not throw it at employees. Two futures are possible here. One, where AI-driven burnout pushes top talent out. Another, where smart adoption, led by real strategy, transforms work. The real question isn't, will AI change work? It's, will we change the way we work because of AI?
In 2025, 64% of all venture capital in the U.S. has been allocated to artificial intelligence startups.
Venture capital investment in artificial intelligence hit $50 billion in the second quarter, accounting for nearly half of all VC funding.
Companies like OpenAI were valued at $300 billion without even being profitable or publicly traded.
OpenAI at $300 billion, is that too expensive? Is it a deal?
In 2024 alone, Google, Amazon, and Meta spent over $400 billion on AI infrastructure or startups.
A $20 billion pledge from Amazon to build artificial intelligence innovation campuses.
However, 70% of these funded AI startups still do not generate real revenue. This has raised alarms among some experts who claim that the AI boom could be turning into a bubble, like the dot-com bubble of the early 2000s.
Hype cycles come and go. The metaverse, Web3, crypto. What about the mother of all tech cycles, the dot-com bubble and burst? So right now, are we in the middle of another one with the generative AI and ChatGPT?
So, how AI became the new dot-com bubble? The dot-com bubble was an economic phenomenon that took place between the mid-1990s and the early 2000s. During that period, the mass adoption of the internet sparked a surge of investment in nascent web-based companies, just as is happening now with the AI boom. The Nasdaq Composite rose nearly 400% from 1995 to March 2000, only to crash 78% by October 2002, essentially wiping out all the gains from that period. Venture capitalists and speculators invested without considering real business models, and many companies went bankrupt after burning through their funding without generating profits. Today, the world is experiencing a new technological boom, the explosion of AI.
Over the past decade, we've become surrounded by AI systems that perceive our worlds, that support our decisions, and that mimic our ability to create.
Since the public launch of ChatGPT in late 2022, investor attention has surged. Global funding for AI startups rose from $18 billion in 2014 to $119 billion in 2021. And by 2023, generative AI accounted for nearly 30% of that total investment in the United States. In the first half of 2025, investments in AI represented 64.1% of the total value of venture capital transactions in the U.S. This has triggered warnings and comparisons to the dot-com bubble. The enthusiasm for artificial intelligence has sparked an unprecedented wave of investment. For example, OpenAI was valued at $300 billion in April 2025, without even being publicly traded. Anthropic, its direct competitor, is seeking to raise an additional $5 billion, despite its products not yet generating revenue.
Amazon is reportedly considering deepening its ties with the AI startup Anthropic through a new multi-billion-dollar investment.
In the first quarter of 2025, the 4 largest venture capital deals in the U.S. were AI-related, totaling $26.6 billion. This capital concentration is reminiscent of the dot-com bubble frenzy, when funds flowed to companies with no finished products solely because of the allure of emerging technology. Big tech companies have responded to this euphoria with an arms race to acquire talent and infrastructure. AI engineer salaries have skyrocketed, with compensation packages reaching $100 million, especially in Silicon Valley.
So OpenAI CEO Sam Altman, he says that Meta is trying to poach his top engineers, offering what he called $100 million sign-on bonuses.
Google, Microsoft, and Meta are projecting a combined spending of $405 billion on AI infrastructure by 2026. This figure doubles previous estimates and represents a jump of over 13% compared to the previous year. Alphabet, for example, announced it will allocate more than $85 billion annually to its artificial intelligence projects. This has had a ripple effect on financial markets. Currently, the tech sector accounts for 34% of the S&P 500 index, an even higher proportion than during the peak of the dot-com bubble in 2000. But despite the enthusiasm, most generative AI products have yet to demonstrate a truly large-scale revolutionary impact. While they may be useful tools, their transformative potential is still up for debate.
We're not saying here that AI isn't leading to be productive. We're just saying that AI tools, yes, they're here and they're being used. The payoff may be more uneven than the hype suggests.
And I think that we really have to be strategic about this because, as we saw in the video, there's this myth again and this concern and risk that could happen. Instead of the dot-com bubble, it could be the AI bubble. And just like everything else that we preach here at Grapevine and on this YouTube channel, we have to hold people accountable. And so if you're an investor listening to this for whatever reason, or if you're a user of AI or a builder of AI, think about what is the actual business model attached to your AI tool. Because there's so many AI tools coming out there left and right, week over week. And it's great. But if we want to actually see AI become impactful to the way that we work, ultimately to the way that we live, we have to ask ourselves, are we building this just to build it? Or are we building this to solve a real pain point, a real problem? And if the answer is no, or if you're an investor and you don't see that, push on them to go into the right direction, because we don't need another AI company just for AI's sake. But what we do need are better companies that might just have AI that can help us achieve those pain points of being solved. I hope that made sense.
Skepticism is another factor, as about 55% of Americans believe AI will be just one more technology among many, without a decisive impact. Restrictive regulation combined with a decline in public and consumer enthusiasm could trigger a sharp shift in market perception. At the same time, the amount of money being invested, with projections estimating up to $7 trillion by 2030, raises questions about the sustainable return on that investment. As with the dot-com era, it is possible that many AI companies will not survive the current speculative cycle. Some will be acquired, others will disappear, and only a few will emerge as sustainable leaders.
What we're doing here at Grapevine is we're being very methodical. We've spent time building the infrastructure of our virtual office platform or our virtual HQ. And we don't even have AI in our platform just yet. And it's kind of funny because when we speak to prospects at this point, some of them will actually say that's refreshing to hear, because you're not just following this trend or this hype curve. You're actually thinking about it from a strategical standpoint and a business model that will actually be profitable whenever we get to that point, and a lot faster. So that's just my 2 cents here. There's a lot of great things that are happening with AI, but we have to be methodical, we have to be strategic, and we have to hold the ones that are hyping up AI so tremendously accountable, because we didn't even get into the parts where these AI data centers are harming communities. Maybe that's a different topic. But this has been the Future of Work Weekly Report. Thanks so much for watching. And as always, as we've ended the last few episodes, if you want the virtual operating system your way, send us or drop a comment, VOS, and we'll send it over your way. Thanks so much for watching. I hope I didn't ramble too much. We'll see you on next week's episode.